Trustee investing. A trustee investment is a loan of your money to a property owner secured by that property owner's real estate. Unlike stocks and bonds, it's a secured investment secured by a hard asset and provides an interest rate far and above any CDs on the market. It's an excellent vehicle for growing as well as maintaining wealth. Most trust deeds have a rate from about 7 to 12% fixed and are usually short-term loans from 6 months to 3 years, or they can be longer if both parties agree. In California, the document that secures your loan by the real estate is called a deed of trust. It's recorded in the county recorder's office and becomes public record. That document names a trustee that can be notified by the lender in the case of payments not being made and gives that trustee the right to foreclose on the borrower's property. You can use money from your self-directed IRA or KEO, your pension plan, a family partnership, a private real estate investment trust, savings account, or mattress money to invest in trust deeds. You can take your money out of your bank IRA and put it in a self-directed IRA and invest it in trust deeds for a secured investment and a giant increase in earnings. Put it with a licensed mortgage broker who has a hard money company and has been in business for many years. He or she can usually help you move your money. Just because it's secured doesn't mean it's a good investment. A trust deed secures the loan but doesn't necessarily make it a good investment. They are two separate things. You should only deal with a licensed mortgage broker who will supply you with a full and complete package with the California mortgage loan disclosure, the very recent appraisal with color pictures, a preliminary title report, financial information and credit report on the borrower, copies of the signed loan documents, your lender documents, and all the information you need for your due diligence, including copies of any leases for a commercial property. Sometimes these documents will come to you in stages as the loan progresses. As long as the borrower makes the payments on time and regularly, all is well. That is usually the case. The thing you have to protect yourself against in the loan is to make sure the borrower has enough cash flow to make the payments and that he has a good exit strategy for paying you off, and most of all, you have enough equity in the property after the loan is written to protect you in the case of a foreclosure. A California foreclosure takes about 3 months and 21 days before a public auction is held to sell the property for you and get your money and expenses back, all with interest at the rate of the note. During that time, your interest continues to accrue, but there are costs involved, such as trustees' fees and maybe fire insurance or property taxes, which you might have to advance when those haven't been paid by the borrower. If someone buys it at the auction, those advances with interest at the rate of your note will be included in the minimum bid, along with the back payments owed to you. Your protective equity should also include the cost of selling the property if no one buys it at the auction and you become the owner of the property. The equity should also provide some profit for your work when you sell it if you decide to do that. Another choice might be to hang on to it and rent it out for a monthly income. You also need to have a reserve for other advances that might come up, like defending a bankruptcy if that occurs in the borrower's attempt to forestall the foreclosure action. After getting the property out of the bankruptcy, that advance with interest will also be included in the foreclosure auction minimum bid and be reimbursed to you when a bidder buys the property at the auction. Historically, the rule of thumb for equity used by private lenders to ensure sufficient protection has ranged depending on the real estate market and the direction it's headed. When the real estate market is good and values are going up, a maximum of 65 to 70% of the appraised conservative market value has been used for good quality property, and a lesser percentage for a lesser quality property. Another way of saying it is the loan has a 65 to 70% loan to value ratio, or as it's called in the industry, LTV. A lower LTV has been used when the market is flat or going down, and again depending on quality. Credit doesn't matter because that's why you have this opportunity, but knowing what it is can reduce or increase risk and thereby affect the interest rate. A correct appraisal is the backbone of any trustee investment. It's the activity that gives the appraiser's opinion of the market value in comparison to other recent sales of similar property in the same or a nearby like area at the date of the appraisal. It must be done by a professional licensed appraiser with the correct license designation to appraise the type of subject property. In some cases, value is estimated by a local real estate broker with a broker opinion letter, and those aren't as accurate as a professional appraisal. You can check any appraisal by consulting the map in the appraisal showing the location of the comparable sales used and seeing that the comparable sales are in the same relative market area as the subject property, usually within the same neighborhood or within roughly a half to a mile away for residential and maybe a bit farther away for commercial. The closer the comparable sales are to the subject, the better, but sometimes the appraiser will have to go to another similar area to find comparable sales if none exist in the subject area. Also, make sure the comparable sales buildings are roughly the same type and size of real estate as the subject, and the pictures of the comparable properties do look similar, and there are definitely pictures of the inside of the subject property. Make sure the appraiser is not making any huge adjustments to try to make a more expensive property seem comparable to the subject. You can also verify the appraisal with the local real estate brokers in the area. It is an opinion of value with about a plus or minus 10% accuracy. You should drive the property yourself and check it out as well as the comparables. It may not be a property you would live in, but if it is saleable and there's a market for it, it works. Certain protections need to be applied. There are other protections you need to have to make your investment as good as it can be. Most important is title insurance to ensure the position of your recorded loan on the title of the borrower's property and to let you know who the owner is. Tax service is another one. It is a service that notifies you if the real estate taxes have not been paid when due. The title insurance and the tax service are borrower expenses and should all be covered in the loan. Make sure you get the original signed note and a copy of the recorded deed of trust with a stamp showing it has been recorded by the county recorder's office with the closing package from the escrow after the close of escrow. For your safety, always wire or deliver your check for your trustee investment to the title company, not the escrow. The title company will make sure your money is dispersed correctly and that you get it back if the loan falls through. That is my opinion. The last thing to cover is the servicing of the loan, collecting the payments. If you've been investing in trustees for years and doing your own servicing, you can do it yourself. If you just don't want to be bothered with servicing your loan or you're new to trustee investments, you should have professional servicing for your loan. There are strict state rules and regulations that apply to servicing a loan, collecting payments, and dealing with the borrower to work out any problems with them. There are private lenders servicing companies that charge reasonable fees to service your loan and deal with the borrower for you. They are usually well worth the cost. I don't believe a mortgage broker should service loans for their private lenders. If the broker gets into some type of legal trouble and goes into bankruptcy, the servicing of all that cash flow of monthly payments to you, the private lender, could be stopped. That again is my opinion. I feel that it's better to have the servicing done by a separate professional, or if you are an experienced trusted investor, do it yourself if you have the knowledge.